Okay, folks, we're ready to get started. You know what next week is, right? Spring break. Yeah, so I'm sure you will enjoy yourselves, and you should. And I will not send you emails for a full 7 days. 7 days you can start it, but I will be back again. So I'll tell you when the 7 day when will start. I'll probably send you an email tomorrow. So it's whatever the 7 days from start to end. Okay, but use it wisely. No? Use it wisely in what sense? Some of you are going to be forlorn, stuck in New York. All the rest are going to go off to spring break before, instead of feeling sorry for yourself, get your evaluation done. Right? There's nothing else for you to do anywhere. Right? You're not like you're on a beach and you can enjoy the beach. It's New York City during spring break. So keep working on your evaluations. So what I'd like to start with today is to continue that storytelling aspect. Now, often when you talk to people who do valuation, they say, I don't tell a story, I just do spreadsheets. I'm a numbers person. Which is an absolute lie, because when I show you a spreadsheet, implicitly I'm always telling you a story, right? So I'm going to actually give you some numbers from a spreadsheet, and I'm going to ask you to reverse engineer the story you would need to get these numbers to work. So you're looking at a valuation where the analyst has estimated a compounded annual growth rate of 50% a year for the next 10 years. Remember what a 50% growth does for the next 10 years, right? As estimated an operating margin of 20%, which is twice the industry average, and as a low reinvestment given growth, the 50% growth, and a cost of capital of 7%, below the market average. So basically high growth, much better margins than the industry, low cost of capital, very little reinvestment, right? So I'm just going to take pieces, and I want you to guess what the story has to be to justify these numbers. First, is this a small company, you think, or a big company? What do you think?
Small company with a lot of growth potential.
So it's got to be a small company. Why? Because you need that really tiny base to get away with 50% growth. Already you can see if it's a $100 billion company, and if they're doing this in NVIDIA, you're already leaving the room, right? Because it's not going to happen smaller. Yes?
Wouldn't the low cost of capital kind of
We'll talk with each one. We'll talk about that, because in a sense, then I'm going to ask you: do this collection of facts actually make sense in a story? Can you see a company have with that? But you're right. No, but what about the total market? Do you think it's a stable market or a growing market? Probably a growing market. It's very difficult to get 50% compounded growth, because remember how you get growth? You get it from market share. And what makes it likely to be a growing market is that combination of high margins going with reinvestment. So competitive advantages, strong or weak? Yeah. Why? Because they're growing fast and maintaining higher margins. And in terms of capital intensity, what kind of business model do you think can give rise to something like this? Low intensity, high intensity? Low intensity because of CapEx. And finally, in terms of the nature of product or service they provide, discretionary or non-discretionary?
non-discretionary because the
Cost of capital. Now, you can actually check the company, and if you don't see these things, and you can say these numbers don't make sense. That is the essence of bringing storytelling in. You're not being the skunk in the room, you're asking. And the point about, do all these things fit together? This is a very strange company, right? Because it's got low reinvestment, it's got low risk, it's got high growth and high margins. And you're saying those don't go together. So today we're going to start the session talking about improbable and implausible. This is an improbable valuation, not impossible, because have there been companies that have been able to grow a lot, maintain high margins with a low cost of capital? Yes, but they're special companies. So we'll talk about how to check for that. Second, every valuation is embedded in it a story, right? So you tell a story about a company. And here's a depressing thought. Do you think that story might change between now and May 6th, which is the day your final project is due? Let's think of some of the things. Let's say your company has not come out with an earnings report yet, and it comes out with an earnings report day after tomorrow. Could it change your story? Yeah. What are you looking for in an earnings report that could change your story? A surprise of some sort which changes the long-term trajectory, right? So if the company says, last year because the dollar was stronger, our earnings were 30% below expectation, he's saying, I don't care, dollars get stronger or weaker, this is not going to change my story. But if they say, look, we're leaving China as a market because it's too difficult for us to compete there, that could change your story. What about macroeconomic changes? In through what dimensions could they change your story? What's the first effect of macroeconomic changes? Interest rates, inflation.
Change the way you earn cost of capital.
It could change your risk premium. It could change the risk-free rate. So that's the first order effect. Second order effect, if there's actually an effect on the economy, you're saying, what will that do, at least in the near term? That's why I actually separate year one from years 2 through 5, is to give you that flexibility to say, hey, next year could be a tough year or a really good year. Right? What about regulatory changes? What kinds of companies do you think that you'll see that impact? Healthcare, ride sharing, right? Big deal now. Cannabis, huge, right? This could make or break your valuation. If you had a federal law change next month that makes cannabis legal across the country, it's going to boost the value of every cannabis company tenfold, fivefold. Because it's very difficult to operate a cannabis company in the US now, because you could go from Colorado to whatever the next state is. My state geography is not particularly good, and you could be breaking the law. I keep telling my kids, you leave California, you got weed in your pocket, not a big deal. But if you land in Alabama with weed in your pockets, could be a really big deal. Because as long as you have different state laws, in fact, cannabis companies can't go to a bank and borrow money because banks don't want to be involved in something that could be illegal in some states. Earnings reports from other companies. Give me a story of how that will play out. Yeah.
So I heard this before in like the waiting room.
The what?
Like a waiting room thing.
I'm sorry, I can't hear.
There's supposed to be a Zoom for this.
Oh, is the Zoom not on?
Yeah. Sorry, that wasn't the answer.
What am I logged into then? Oh, maybe I'm logged into the wrong. Yeah. You know what? Let me get. Sorry about this, folks. But if you're watching the recording, maybe. Yeah. Thank you for letting me know, though. I would never have known. So let's see if I'm logged into the wrong thing. Oh yeah, I'm logged into the wrong class. No wonder it's not. It's the problem with having 3 different Zooms and. Let me share my screen. Let's do this right again. Okay. They should be on now, right? They're on? Thank you. Yeah. Earnings reports from other companies.
Real industry headwinds or tailwinds that might be worse or better than expected, and also if they have a specific new product or some deterioration, that can either be a bigger opportunity or a bigger risk for your company because the other company will be grow or shrink more.
Tesla reports bad earnings. Rivian is going to see an effect as well, because there is part of your story that is about electric cars and how they're being bought. So when you see a company in a sector report, doesn't have to be. It can sometimes, bad news for a company can be bad. This used to be particularly true for automobile companies in the last century, where GM, Ford, and Chrysler, since they moved in kind of lockstep, and one company reported bad earnings, you'd see stories change for the other 2 companies. So the answer is all of the above, which means your story is not ever done, right? You're going to turn in a story at the end of this month for my feedback. I'm going to say that it looks good. Just don't sit on it, say it looks good, we're done. Now keep your eye open for something that could significantly change the story, because it is going to affect your value. So let's go back to where we were in the valuation notes, and I think and pick up there. So I think we were on page 240, 260, 250, no, 240, 256 and 257. Yeah, you're right. 257. We were talking about possible, plausible, probable. Possible is the weaker test, plausible is tougher. So I'm going to give you examples of impossible stories, implausible stories, and improbable stories. Let's start with impossible stories. You know what a fairness opinion is? Anybody heard of fairness opinions? What is a fairness opinion?
It's like another investment bank or some other firm will come in and then basically determine whether it's transaction.
In what context? Usually in an M&A transaction, a fairness opinion is an opinion rendered by a banker saying this deal is at a fair value. I'll give you the origins of fairness opinion. In 1986, the Delaware courts actually ruled that if companies did not want to get sued after an acquisition, because remember, companies make mistakes, they overpay, shareholders can sue them, they said the defense you can offer as a company against getting sued is to have a fairness opinion. So guess what? Every M&A deal now, the acquiring company will get a fairness opinion. It's a fig leaf, basically, because the reason I call it a fig leaf is I've never heard of a deal that doesn't go through because you could not get a fairness opinion. The Time Warner AOL deal, one of the worst deals of all time, there was a fairness opinion that said that was a fair deal. So fairness opinions are really kabuki, discounted cash flow valuations. You know the kabuki dances, right? They're very elaborate, and while you're watching it, nothing happens. Right? A kabuki DCF, it looks like a DCF, it acts like a DCF, but the end is already predestined. The end is to justify what they're. But so everybody plays this game. So I read fairness opinions for comic relief. Why? Because they're really not valuations. If you want to see every rule in valuation broken, read fairness opinions because they're public information. This was about 7 years ago when Tesla bought Solar City, one of the most hopelessly conflicted deals of all time. Think of why. Who's the largest shareholder in Tesla? A guy called Elon Musk. Who was the largest shareholder in Solar City? A guy called Elon Musk. What a coincidence. Same guy. Who is the CEO of Tesla? A guy called Elon Musk. Who is the CEO of Solar City? A guy with the last name Musk, but with a different first name, Kimball Musk. Yeah. So they knew they were going to get sued from every direction, so they decided to buy protection. By doing what? Remember, this was it was an exchange offer where Tesla shares were going to be offered. So basically, you needed to show that that exchange ratio was a fair one. So each company goes out and hires an investment bank. Solar City hires a bank called Lazard. Have you heard of Lazard? It's a New York-based, old. It's in fact, it was very involved in saving New York City in the 1970s when the city almost went bankrupt. So Lazard works for Evercore. I'm sorry, with Solar City, and Tesla hires Evercore. Heard of Evercore? Another New York-based investment bank, big name. So two big investment banks, and their job is to justify the ratio. So I pick up after they filed the fairness opinion, I pick up the fairness opinion, I start reading it, and I focus on the Evercore fairness opinion for Tesla. So they've projected numbers out, and they have revenues and margins and cash flows and growth, and they get to year 10, and they estimate a growth rate of 6% a year forever for Tesla. My first reaction was, hey, what currency are you doing the valuation in? Maybe in Argentine pesos, and you forgot to tell me? It was in US dollars. In 2016, when the T-bond rate was 2%. This is an impossible valuation. What will happen to Tesla if it grows 6% a year in an economy growing at 2%?
Basically, infinite value.
Forget about infinite value. We'd all have to live in our Teslas, eat our Teslas, get healthcare from our Teslas, get entertained. I know Teslas are really smart cars, but this is beyond even a Tesla's capacity. And then what happens after you become the global economy? The only way I can get the story going is to bring SpaceX into my story. And maybe you can launch Teslas into outer space. You find Martians first. You get them to buy your Teslas. Maybe that is the story that's not. This is a plain impossible story. You know how much Evercore got paid for this fairness opinion? $8.3 million. There's no justice in this world. This is about as bad a discounted cash flow valuation as I've ever seen. I said some terrible things about Evercore in that blog post that I wrote at the time. You can go read it. And a few months later, I was actually in Evercore. And I get into an elevator with 3 bankers, and one of them was involved in the deal. I tried to put a brown paper bag on my face. Nobody recognized me, and he said some terrible things about us, and I said, you deserve it. I mean, what else can I do? Okay. That is an impossible valuation. Let's take a second example. Now, I've kept asking this question. None of you seems to admit to the company you're valuing. You're afraid. I think I would pick on you if you tell me your company. Let me ask a question again. Is anybody here valuing Netflix? Okay. If you say so. But at the end of the semester, I'm going to show you the list, and there'll be 6 people valuing Netflix, I'm sure. Because every semester, at least half a dozen people. So I have fun with the valuation. It's a fun company to value, right? Great potential, product you're intimately familiar with, probably too familiar with. Maybe that's why you're putting off picking a company. No. So about 7 years ago, I get a Netflix valuation. And I get a value which is 5 times the market price. This is a company that's already richly priced. You get 5 times the price. I'm wondering what did the person do? So I look at his projections of revenues. He has a growth rate, but in year 10, his revenues were $600 billion. So I call him in and I say, can you come in and talk to me about your Netflix valuation? I'm very intrigued. That's exactly the word I use, intrigued. So he came in, and so I said, do you have Netflix? He said, yes. And I said, how much do you pay over a year? At that time, Netflix was much cheaper. It was like $8.99 a month or something, $7.99. He said, about $100 a year. So let me ask you a follow-up question. You have $6 billion in revenues in year 10. How many subscribers would you need? He pulled out his calculator and said, you don't need a damn calculator. You pay about $100, $6 billion, $600 billion. You need about 6 billion subscribers. He said, I don't see where this is going. I said, I have 2 more questions, then you can leave. I said, how many people are on the face of the earth? He said, I don't know. I have to check Wikipedia. I said, I'll save you the trouble. It's about 8 billion people. I said, tell me what I'm missing here. Is there some law that's been passed that every man, woman, child, and pet has to have their own Netflix account? He said, don't be absurd. I said, I'm not the one estimating 600 billion revenues, you are. And you know what he said? I just extrapolated based on last year's growth rate. Cautionary note. When you project growth rates can look reasonable. The number you should be checking for your revenues is not, am I using a 50% growth rate? Does that look okay? Look at your revenues in year 10 and ask yourself, is this market big enough for me to deliver these revenues? A company that gets 100% plus market share of a market, that's a fairy tale. You can't get there. One more example of an impossible valuation. You project out cash flows in the next 10 years, you get to year 10, you put in a 3% growth rate, and you say it's because they can cut costs. They're a very efficient company. I can understand cutting costs and growing next year, 5 years, but in perpetuity, this is a fairy tale, and here's why. You can cut costs and become more efficient. Your margins improve. Your margins go from 20 to 25 to 30. But is there a ceiling on your margin? You can't get above 100%. This cannot be a source of perpetual growth. Impossible valuation. I sent you a link to this post I wrote. I had more fun writing this post than any other post I've written about dysfunctional DCF. It's a hall of shame of DCFs. I have the Kabuki DCF in there. No. So basically, these are impossible valuations, and I actually look at actual banking valuations, and I say that goes into the hall of shame here. No. Impossible valuations. Let's talk about implausible valuations. The essence of implausible valuations can happen, but you better have a really good story. I'll give you a few examples. A company that grows without reinvestment, at least in the near future. What kind of companies can do that, at least in the near future? No? But the reinvestment is R&D, right? So then to finish the story, so their R&D, they're growing, they're living off past R&D, and because there's a gap, you could say, so one could be that you're a pharmaceutical company, you did the R&D, can Novo Nordisk grow for the next 10 years without much in reinvestment? What's creating the growth for them? Novo Nordisk is the company that owns the rights to Wegovy and Ozempic, right? Of course, Oprah has now claimed that she is now a thin woman, and Ozempic made it there. I mean, high-profile celebrities basically pushing it. At least for the near term, you can get growth, and it's happened to be at the right place. You created a drug. I think it was for diabetes. Was that what Ozempic originally was? Whatever it was for, you've now found a much bigger market. It can happen, but you better tell me a story that fills in the gap. Right? You have a company that has much higher margins than the competition. What's Econ 101 say? When your margins are much higher, there should be competition, right? So what am I looking for? I'm looking for a filler. Tell me what that competitive advantage is. Yeah. I remember, valuing a company called Almarai. It's a Saudi food processing company with margins of 15%, twice as high as the margins of food processing companies in the rest of the Middle East. And I couldn't quite figure it out. Why isn't competition pushing the margins down? So I talked to somebody who was Saudi, and I said, "Do you know this company?" And he said, "Yeah, I know the company." And I said, "Why is margin so high?" He said, "Have you taken a look at who the biggest shareholders of the company are?" And I went and took a look. And it turned out right at the top is somebody bin Saud. There's a royal family on your side. There's your competitive advantage. With implausible, I'm saying, give me that explanation for why this company does what it does. And then you have improbable valuations. And I have what I call a valuation triangle that I use when I look at your valuation. So I'll give away the triangle so you know what I'm looking for. When I look at your valuation, here's the first thing I'm going to check. I'm going to check your revenue growth numbers. So what are the possibilities? You have high revenue growth, average revenue growth, low revenue growth. Could it be negative revenue growth? Yeah, if you're a tobacco company, medicine. So yeah. Then I check your reinvestment numbers. The easiest way for me to check is to look at the difference between your after-tax operating income and your free cash flow to the firm. That's what the reinvestment is, whether you got that with the sales to capital or something else. Check your reinvestment numbers. There I can get high reinvestment, average reinvestment, low reinvestment, or even negative reinvestment, which means your company is shrinking. And then I'm going to check your cost of capital. You're going to give me a number, right? But if you look at the cost of capital worksheet, I actually have a distribution of cost of capital for companies in the US, where I give you the median, the 25th percentile, the 7th. So basically, I look at your cost of capital and I check, is this higher than the typical cost of capital? Is it lower? If I see high growth in your revenues, typically, what should I expect to see in reinvestment? High reinvestment, low reinvestment, no reinvestment?
High reinvestment.
Generally high reinvestment. And usually when I look at your cost of capital, I should see a cost of capital that is higher or lower than the average. If it's a high growth, high reinvestment company, generally the cost of capital should be higher, right? High, high, high kind of makes sense. Low, low, low kind of makes sense. But if I see high, low, low, there's a mismatch. Doesn't mean it's impossible. But then I'm looking for your story that explains the mismatch. I'm giving away the game of what I'm going to do on March 29th when you turn in your DCF. It's not my job to tell you your revenue growth is wrong. I have no idea whether your revenue growth. My job is to point out parts of your story that don't match and look for an explanation that you might have given. And if you don't, I'm going to push you on what's the rationale for how this company is able to maintain high growth, low reinvestment, low risk. And I'll give you one example to kind of illustrate the kind of company we can pull that off. It was about 7 or 8 years ago, somebody in this class was valuing an infrastructure company that was building toll roads in Asia. They had 30% growth for the next 10 years with almost no reinvestment and very low risk. So I called him in and said, "How do you explain this?" And he said, "It's easy. The last 20 years, they've been building the toll roads. They're an infrastructure company. Those toll roads have just become operational. So there's the growth coming. Why is there no reinvestment? Because you've done the reinvestment already, right? And these toll roads are often the only roads between major cities in that part of the world. So you got a kind of monopoly. Makes sense?" I said, "Okay." So I'm not saying that when you have a mismatch, something is wrong, but you have to think through in your company why that mismatch exists. And that's what your story is about, telling me why that mismatch is okay for this company. So I check my own Uber story. And as I said, the person that you have to worry about the most looks at you in the mirror every morning because you're the easiest person to fool, because you fall for your own story. You fall in love with your own story. So what was my Uber story? Urban car service company attracts new users, local networking benefits. You know what? In 2014, I felt completely comfortable telling that story because it reflected what Uber was already doing. They were already in 200 cities, urban car service company, attracting new people. Bay Area, they tripled the size of the car service market by coming in. So every part of the story, I could point to something and say, that is it possible? Is it plausible? Is it probable? Clearly, I passed all three tests. Could I have told a bigger story for Uber in June of 2014? Sure. And if I tell a bigger story, I need to play more defense. I mean, it's advice I give founders, right? When you go as a founder, you're tempted to tell the biggest story you can because you'll attract more capital. But I say, look, if you make your story big, you're going to have to play more defense. Tell me how you can get away with this story. Just as a cautionary note, once in a while, as an investor especially, you will run into a story that you fall in love with. Call these runaway stories. And here are the ingredients you will usually see in a runaway story. There's usually a charismatic storyteller, somebody who's telling the story that you say, that's an amazing person. Okay? They're telling a story about disrupting a business you've never liked, like universities. Okay? Because you had a tough time getting your grade changed from last semester. Say, somebody disrupt this NYU's business model. And to top it all off, the storyteller tells you how they're going to make the world a better place. Let me give you a story, and you tell me whether you want this story to be true. It's a story about a 19-year-old who drops out of Stanford. Who does that? What's the admission rate at Stanford? -3%? Unless you're, of course, a rhythmic gymnast or something, you came in through the side door. It's really difficult to get into. This person gets in and drops out in their sophomore year to start a new business. You're saying another tech geek starting a software business. Let's make the story interesting. It's a woman who drops out and starts a blood testing business. Do you guys have experience with the blood testing business in the US? I remember the last time I tried to make an appointment at Quest Labs. I called and said, I'd like to make an appointment. They said, we have nothing open for 3 months. I said, okay. What time? 3 months from now? 4 a.m. or something like that. I said, I can't make it at 4 a.m. They said, we have an opening 5 months from now at 8 a.m. I said, I'll take it. I show up at 8 a.m. 5 months later. They make you wait an hour. Why? Because they can. After an hour, the door opens and a nurse comes out. She looks like Nurse Ratched from One Flew Over the Cuckoo's Nest. I said, come on in. Your knees knocking together, you go in. She has 2 buckets next to her. So what are those buckets for? Your blood. What are you going to do with 2 buckets of my blood? Have you noticed how much blood they take out of you? How many vials of blood do you need? Maybe Dracula shows up every night. I don't know what they do with the blood. So they extract half your blood, anemic, you crawl back out of the room. You get in your car, you go back home, you don't hear from the lab for like a month. You call and say, what happened on my blood test? So we have the results ready. Can I get them? No, we can't give them to you. Why? Privacy laws. It's my blood. We'll give it to your doctor. You got to make a doctor's appointment. So you go through this whole process again. You call the doctor. We have an opening 5 months from now. You show up. They make you wait an hour. You walk in. The doctor's looking at your blood test results. Looks very concerned. And after 15 minutes of torture, he says, there's nothing wrong with you. Don't get too relieved, because 2 months later, you get the ultimate indignity, which is a bill from the lab saying, you know what, the insurance company didn't pick up 80%, it'll cost you $25,000. I don't blame you at that point for hating Quest Labs. Sure, you have a 19-year-old. Here's what she's going to do. She's going to, instead of taking 2 buckets, she's going to take 2 drops of your blood. That sounds so much better already, right? She's going to put in nanotainers, not buckets. It's very scientific, sounds advanced. She's going to run 32 tests on your blood, and 45 minutes later, she's going to email you the results. This is like she's in the 21st century, right? And the whole thing's going to cost you only $75. And you know what? she is so magnanimous, she's going to give away these blood tests to parts of the world people can't afford blood. She's going to save hundreds of millions of people with blood. Don't you want this story to be true? If we were making a movie, this sounds like an amazing movie, right? This is, of course, the true story of Elizabeth Holmes. She founded a company called Theranos, 2 drops of your blood in a nanotainer. And she was going to change the blood testing business. And to show you how much the story had caught on, VCs, including some of the biggest names in the business, had valued the company at about $9 billion. This is the middle of 2015. Walgreens was talking about putting Theranos labs in every Walgreens around the country. And the Cleveland Clinic, one of America's premier health organizations, was talking about how amazing this blood test was. And overseeing all of this was a board of directors, which when I first looked, I wasn't sure whether this was a CIA front that I was looking at or a blood testing company. What's Henry Kissinger doing in a blood testing? Talking about the Iron Curtain and how much blood is behind or in front of the curtain? I don't know. But there's actually you take a look at the last column. Okay? You got Henry Kissinger at 92. You got Bill Perry 88. George Shultz at 94. There's a pattern here, right? If you're a CEO and you want to put together a board that will never ask you questions, here's a tactic to try. Pick a bunch of 80 and 90-year-olds, put them on your board. Have a meeting. Put pillows in front of every seat. Have a backup ambulance. You never know. But nobody's going to ask you a tough question. But when I looked at it in 2015, somebody asked me, what do you think about Theranos? I said, no, nothing about the company. But given that the Cleveland Clinic, Walgreens, and these ventures, there must be something there. Somebody must have asked the question. You know the question you would ask, right? If you're investing in a blood testing question, what's the one question you want to ask and get answered before you put money in? Does the blood test work? This is not some nebulous AI company with things. This is a blood testing company. I assume somebody had asked the question, and I was wrong, because in October of 2015, a Wall Street Journal reporter decides to ask the question, does this work? And the results were actually in the public domain. He went to the FDA and said, has Theranos filed for these 32 things they claimed? And the FDA said, no, they did file, but we've approved only one of the 32. And he said, why? He said, because the tests are a little noisy. You know what a noisy blood test looks like? Trust me, you don't want one. The doctor says, you know what? You could be dying. Or you might not. Just go home and in a few months we'll follow up. You're not going home, right? You're going right to the emergency room, so I could be dying. This is not a feature you want in a blood test. And over the next 6 months, Theranos just imploded. It turned out that even the one test they passed, they didn't even use their own nanotainers. They'd use the actual traditional Quest Labs equipment. They were committing outright fraud. 6 months later, guess what this $9 billion was? 0. Elizabeth Holmes had been banned from the blood testing business for 3 years, or 5 years, or whatever it was. She had a criminal case filed against her, and she ended up moving to San Diego, about 6 miles away from me. A few months ago, the trial actually happened. Shows you how much there's a lag between when she was found guilty, so I won't be running into her on the streets of La Jolla anymore, at least for the near future. Right? But in October of 2015, after this started, I wrote a piece on, I'll send you the link to it. And the question I was asking, because after the fact, what did everybody say? Well, this is obvious. Why didn't somebody ask the question? So here's the question I raised. I said, let's say it was June of 2015. Elizabeth Holmes was at the peak of her glory. She was a celebrity. She actually came to New York. She gave a talk. I think 3,000 people were in the audience. People brought their daughters so that they could see a self-made billionaire. I said, assume you were in that June 2015 meeting and Elizabeth Holmes is on the podium and you stand up and you ask that question. Would you have had the courage to do it? Does your blood test work? You'd have felt like the guy who shot Bambi's mother. Have you ever seen the movie Bambi? It's traumatic, right? Bambi actually is left I guess an orphan, you can say. The mother falls, and I always wondered about the hunter who shot Bambi's mother and how much therapy he probably had to go through to deal with it. And I'm sure you didn't think about it, but it felt like Bambi, the guy who shot Bambi's mother. I mean, you shot down a dream. That's what happens in a runaway story. You get afraid to ask questions because you want the story to be true. But ultimately, when you have runaway stories, it comes apart sooner or later. Because what is the story built around? A person, a storyteller. And when that storyteller develops feet of clay, the whole story comes about. You think we'd learn from Theranos? We'll never let this happen again? No, it's going to happen over and over again. I remember in October or September of 2019 when this company called WeWork filed an IPO. WeWork was the CEO of the company, was a guy called Adam Newman. He claimed there was an R right next to the we. He claimed he invented the word we. I don't know how this works. Whenever I say we, do I have to send a check to him? And this is one of the first companies that was born out of a TED Talk. Because 7 or 8 years later, he'd give a TED Talk about community. It's kind of ironic that the most narcissistic person in the face of the earth is talking about the importance of we. I mean, Adam Newman was incredibly narcissistic. But if you think about WeWork, the business model, you look at it and say, that makes no sense. You lease a property out for 40 years and you sublease it out for 6 months. You're almost asking to blow up the business. The question is, how did you get this big? And because at the time of their IPO, people were talking about a $90 billion valuation for WeWork. So what in that case prevented people from asking stories? One is the fact that their biggest investor was a man called Masa Son, who had through SoftBank. And what was the reputation of Masa Son in 2019? Genius. 300-year plans. Who makes 300-year plans? Narcissistic, arrogant people. Let's face it, right? Anybody with any sense of humility knows that making 300-year plans is like looking at the stars and say, strike me down, God. And can you imagine those meetings with Adam Newman and Masa Son in one room, two incredibly narcissistic people, each feeding into each other's egos? But the problem is, outsiders said, I'm not going to ask a story. Masa Son thinks it's worth $47 billion. Runaway stories will be around as long as you can. So once in a while you see a runaway story, don't get run over, because it's easy to get caught up. One final tangent on this part of storytelling. What's the biggest, right now when you look at around the market, what's the biggest buzzword out there driving stock prices? AI, right? And one of the few advantages of getting older is I've seen this movie before. The 1980s, I saw it with the PC business. PCs took off 82, 83, 84. In the 1990s, what was the big revolutionary change? The internet, right? Then in the 2000s was smartphones. And the last decade was social media. Each hugely revolutionary, changing not just businesses, but the way we live. So now it's AI. And let's say you're an entrepreneur. Any of you plan to be entrepreneurs? Come on, you can put your hands up. You want to be an entrepreneur. Everybody wants to be an entrepreneur, right? Who wants to answer to a boss? You are the boss. You could be a bankrupt boss, but you are the boss, right? If you know, but assuming you're not an entrepreneur yet, but you know other entrepreneurs, let me ask you a generic question about entrepreneurs. Do entrepreneurs tend to be diffident people or overconfident people? You got to be overconfident to be an entrepreneur, right? Because you say, I can pull it off. You're an overconfident entrepreneur, you're looking at AI saying, I can start a business, this is going to be huge. So you start a business. And where do you go raise capital? From venture capitalists. Let me ask you a generic question about venture capitalists. Diffident people or overconfident people? Incredibly overconfident. They think they can pick winners. So you got an overconfident entrepreneur with 3 VCs who think they've picked the winner. So there's a bunch of overconfidence there. And you're not the only cluster. There are 100 clusters like yours all across Silicon Valley, all across the world, looking at this big market saying, I'm going to be the one. What does overconfidence mean? When you value a company inside that cluster, how does overconfidence play out? Or when you do your revenue growth numbers, you say, I'll get 80% growth. I am going to be the winner. I'm going to get the biggest market share. So inside each cluster, you think you're being rational when you make your projections, but you're caught up in that overconfidence. See what this is going to lead, right? Each cluster is going to be valued higher than it is because it underestimates the work involved in winning and it overestimates the potential payoff. So if I take the 100 clusters, I take the values of the 100 clusters, I add them all together. By definition, what am I going to find? The sum of those values is going to be much higher than the value that can be sustained for the market. Eventually, does reality strike? Yeah, eventually. And then what happens? There is an adjustment down in value. Some of those companies go out of business. And what do we call that in the rearview mirror when that happens? Bubble, right? And then what do? We wag our fingers at you terrible speculators. No. And then we talk about bubbles being a bad thing. We shouldn't allow it. Let's pass regulations. Let's pass rules. Let me tell you something. If you have markets, bubbles are a feature, not a bug. And I said this last week on CNBC, and I got a lot of heat for it. What's so bad about bubbles? Humor me. What is so bad about bubbles? They pop, but that by itself means nothing. So tell me who's damaged. Oh, there's Silicon Valley people who bought $15 million houses might have to move to a $1.5 million house. I feel really bad about those people. Is there damage? But the damage is basically in the space from people who were essentially at the heart of the bubble. You're saying, what about investors? Did anybody put a gun to your head and say you got to buy a .com stock? No, you did, and then it blows up. So if you look at those bubbles, there is a cost. But let's take the .com bubble that burst. Did it change the way we live? When was the last time you went into a travel agency? You know what a travel agency looks like? You walk in through this door and there are 4 busy looking people sitting at desktops with computers. That used to be a dazzling, they have computers in front of us. They must make them special. And what they had was a special conduit that let them know when flights were leaving and when flights were landing, and they could find you the best flights. Now you can see already, I won't do that. I'll just go on Expedia and do it myself. Change the way we live. I'll take PCs. Of course it changed the way we work and we live. Smartphones, absolutely. Bubbles are essentially markets' way of dealing with big change. And essentially it's a feature because human beings overreach. That's what allows for change. If we all were systematic about assessing the likelihood of change, change wouldn't happen. Yeah? In fact, I ask people, do you want to live in a world run by actuaries? If we lived in a world run by actuaries, we'd still be in caves. Why? Because they're looking at fire saying, this is a risky thing. We have to look at all the assessments. Maybe a few thousand years from now, we'll come to the conclusion it's safe and you can leave the dark cave. You cannot have big change without bubbles. It's almost like one is connected to the other. So if you don't want bubbles, don't ask for big change. Right? They go hand in hand. Yeah.
So then you can make a career out of just shorting every...
That's the question is, can you take... That's actually a very good question, right? Because I've thought about this. Because if there is a bubble around everything, you're saying, why don't I just... First, why wouldn't you want to sell short every AI stock? In 2 weeks, you're going to be bankrupt because NVIDIA is going to go to 1,500. No, 6 years later, so I told you so, but fat lot of good. You're bankrupt. Right? The first is, you're saying, why don't I sell short on all of the companies? Because many of them will be private. And so in terms of practicality, but there is a long-term strategy you can adopt. And I remember at the towards 97 or 98, there was actually an internet index that was created. At that time, you didn't have index funds, but if you had an index fund, it might not have been a bad idea, but even there, you'd have to check on the practicalities. How long can I sell the short? Yeah. it is difficult to monetize. So what should you do in a bubble? One is you can trade the bubble and try to make money on it, so that's always a strategy. The other is you can step back and say, I'm not in the bubble. But don't lecture people who are in there. What business is it of yours if they buy NVIDIA at $900? I've never understood this urge that people have to. It's almost like they're religious. They're like the Puritans. You sinful tech investors. Hell is waiting for you. And they keep wagging their finger. Hell is waiting for you. And they just, it's really depressing hanging out around them because they're so busy telling the rest of the world about what's awaiting them at the end of this process. So if you think there's a bubble, step back. Don't try to explain it away. It is part of the process. And accept that there will be a correction. That too is part of the process. And don't, when that correction happens, there'll be people who've said, there's a correction coming, there's a correction coming, they've been doing it for 20 years. One of these days they're going to be right, they're going to be the new gurus. Look, he called the AI bubble. He did nothing of the sort. In fact, we Nouriel Rubini used to teach her, and I liked the guy. But every time I got an elevator, it was like getting in an elevator with the Eeyore. Have you ever seen the Winnie the Pooh? It's going to be a depressing day. Today's I've never seen Nouriel have an upbeat view in all the years. And at some point in time, you ask, what is the benefit of having somebody who keeps telling you, you're in a bubble, you're in a bubble, you're in a bubble. Oh, finally, I told you so. And you go back to saying that again, over and over again. I'm sorry, go ahead.
Are you starting to step back nowadays or not?
From what?
From maybe companies that are related to artificial intelligence?
What made you think that I stepped in the first place? The early investment, 2018, I bought NVIDIA, and I admitted up front, I didn't do it because I saw AI coming. I just got lucky. I am like the Novo Nordisk of investors, right? I thought I was buying a diabetes drug, and it turned out to be the weight loss drug of the. I got completely lucky on NVIDIA. Now the question is, now that, because as you know, I've sold half and then I sold another half, and he keeps asking me, do you want to sell a little bit more? But at this point, all I have to do is decide whether to sell or whether to, remember he said every bubble creates winners. Is NVIDIA going to be one of those winners I can ride? It might be, it might not be, but at this stage, that's the only company that I have that is really AI driven. I own Microsoft, but there's nothing in my value that came from an AI perspective. And I bought it in 2014, at which point, it wasn't even in the cloud business, right? So I don't buy it. But the point is, when people say AI is the reason this company has a high value, so it's plausible, but you got to fill in the gaps, right? So that's what I call the big market delusion, and it's I've written a couple of posts about it. And it's essentially about this process of individuals thinking they're being rational, but overconfidence driving the price up. As I said, when I look at DCFs, I'm looking for internal inconsistencies. And Tesla is one of my pet obsessions. I've valued it for since 2013. And I'm always curious about equity research analysts who come up with a very different view. So this is actually one of the highest profile equity research analysts who tracks Tesla. He's been tracking the company for a decade or more. And he actually is a person who used to be so optimistic about Tesla that I remember he got into an argument with Elon Musk, and he told Elon Musk he was being too pessimistic about the future. Right? So this was about 10 years ago. I'd valued Tesla. I'd come up with like $180 per share, and he comes out with an equity research report where he comes up with a value of $640. And I'm curious, what's the story you're telling? What do you see? So I open up the report. The first warning was like 200 pages long. You don't need 200 pages to tell a story about a company, but it was filled with pictures. And I get to, I don't know what page it was, 155. There's a D.C.F. That's what he called it. So I'm going to stay with this terminology. He said, I've done a D.C.F of the company. I said, okay, I'm very interested in the D, the C, and the F. And this was the page. So I started going through the page to see what he'd assumed that gave him a value 4 times higher. So I started with the top line where he said the number of cars. At the time that we both value the company, Tesla was selling like 24,000 cars. And he projected that the number of cars sold could increase to 1.1 million. Possible? Sure. Plausible? Absolutely. Every year, 86 million cars get sold around the world. 1.1 million. I said, okay. In fact, his projection of number of cars was very close to mine at the time. So I said, this is pretty good. We're on the same page. Then I said, maybe he's assuming much higher margins than mine. And if you go down, there is the EBIT. Basically, you could see the EBITDA margin, 18%. So you work through the margins. And it looked like he was assuming margins actually slightly lower than mine. And now I'm completely befuddled. Your number of cars and revenues are very similar to mine, and your margins are pretty close to mine. Why is your value 4 times higher? Then I went to what he called his net income, which was really more of an after-tax operating income, an EBIT times 1 minus T. And what he called an unlevered free cash flow, which is just another word for free cash flow to the firm. And what's the difference between after-tax EBIT and free cash to the firm? What is the intermediate that separates the two? It's reinvestment, right? So if I take the difference between those two, and there were like 15 line items, so I didn't have the stomach. I took the difference to see collectively what he was reinvesting. And I ran into a problem. Over the next 15 years put together, his reinvestment was close to zero. So I called the equity research analyst. And he picked up the phone. He was in an airport on his way to California, maybe to worship at a Tesla shrine. I don't know what he did. No. And I said, look, I've been reading your report. It's very interesting. And I'm on your D.C.F. So I decided to stay with the terminology, not throw him off. And I said, can I ask you some questions? He said, I cannot answer those questions. And I said, why not? He said, I don't actually work on the numbers. I have a team that does that. I said, you had a whole team do this DCF? He said, yeah, a team of 6. I said, I'd like to talk to them. He said, I'll be back next week and you can call us. And I said, sure. And I get ready to hang up. He said, you're not going to write on your blog or anything about this in the next week, right? No, I said, not in the next week, but then all bets are off. So I call him a week later. The entire team is gathered together. So the lead analyst comes on and he says, look, I don't work with, and I said, what do you do? And he starts describing, but basically he's a schmoozer. He schmoozed. I love that word. Basically, he talked to managers, he talked to experts, he talked to electric car specialists. So I said, okay, chief schmoozer. Then I said, what does your second in command do? He says, I keep the first guy company when he goes and schmoozes, so I'm the co-schmoozer. Then the third in command says, what do you do? I said, I'm the substitute. I'm the backup schmoozer in case these two guys can't schmooze. I said, who in this group does something other than schmooze? They point to a poor 23-year-old I hired out of Wharton the previous year and say, he's the guy. He did the D.C.F. So I feel sorry for the guy already. Right? Low person on the totem pole, probably getting paid a pittance relative to the schmoozers. Right? So I put him through. He's a smart kid. He got it very quickly. So I said, I see a number of cars. And I said, are you aware of where Tesla makes its cars? And he said, yeah, of course. They make them in Fremont in an old GM plant. And I said, do you know what the capacity of the GM plant is? He said, not really, but no, it's a couple of hundred. It's 250,000 cars on a really, really good day at 100% capacity. I said, we have a problem. Even at 100% capacity, you can make 250,000 cars. You're projecting 1.1 million cars. Where are those cars going to come from? He said, yeah, I see what you're saying. I said, what happened? He said, it slipped my mind. I said, what slipped your mind? He said, when I was making the projections, I took the capex and depreciation of the most recent year, and I just projected them out. In the most recent year, Tesla had not made any big investments, so it turned out that the capex and depreciation, it's at the heart of why financial modeling is so deadly, right? You take the last year, you project out. And I said, do you think you have a problem? He said, yeah, but we can't go public with it. It'll be embarrassing. He said, do you have any ideas? I said, yes, I do, but I don't think you're going to like them. I said, have you ever seen this movie called Willy Wonka's Chocolate Factory? He said, no, but one of the older analysts had, the original version. I said, you might want to watch that movie again, because when I watched that movie, and I was a kid still, I came out of the movie with a burning question. There's only one factory. And Willy Wonka chocolates were all over the world. My question is, how does this one factory manage to produce so much chocolate that it supplies the entire world? It's a very inefficiently laid out factory too, like chocolate rivers running through the factory, And if you watch the movie, the answer is in the movie, right? You remember the scene where Seeing Gene Wilder's Willy Wonka, he points and there's these little creatures called Oompa Loompas. They're always singing and dancing, and while they're singing and dancing, chocolates come flying out. I said, here's what you need to do. Put out a press release that Tesla has replaced all its Fremont workers with Oompa Loompas. You don't need any extra capacity. Oompa Loompas, the cars just come flying out. I call these Oompa Loompa valuations, where people project growth, they don't project any investment in capacity. I don't have a problem with any individual assumption here, but I have a problem with the collection of them in the same spreadsheet. So the next time you pick up an equity research report, go to the D.C.F and check for yourself whether you get Oompa Loompa valuations at play. So now I think I'm ready. Took me a while to get there, but I'm ready to convert my story to numbers. So what is my story? An urban car service company, right? How does it play out? The total market that I had Uber going after was the global car service market. You know how difficult it was for me to put a number on that market? Who dominated the global car service market till ride sharing came along? Taxi cabs. And the problem with this, most of them were privately owned and they were localized. So I actually had to go city by city, where they taxi, like New York, there's a taxi and limousine commission. They have an estimate of what. And I was able to do this for about 45 or 50 cities. And then I ran out of both energy and information. And I just doubled it. I came up with about 100 billion. Show you how dangerous Google search is. At the time I looked in Google search, nobody had an estimate. 6 months later, go to Google search, maybe there'll be a good estimate. What's the size of the urban car service market? The first finding comes up. 100 billion estimated by Demodrin. I said, okay, if you guys really knew how I estimated the number, you wouldn't be using it, but it looks so official, 100 billion. So watch out for that Google search and what it gives you, because who knows what the person made up along the way. 100 billion was my total market. That's the urban car service part of my story. What did I say Uber had? Local networking benefits. Remember what that implied? That there might be 8 or 9 different ride-sharing companies in different parts of the world. How does it play out? When I think of market shares of this market, I cannot give Uber a 40% market share. I gave them a 10% market share, huge by car service standards, in 2014. Consistent my story. I did allow the $100 billion car service market to grow at about 6% a year. It was actually growing at 1 to 2%. You're saying, where's the extra 4% coming from? My son and my niece and people like him saying, look, I'd never take a cab, but I'm taking the car service. And then I got to margins and said, what does Uber do? It connects people, right? There's really no costs. It's an intermediary business. And in steady state, the margins should be huge. All you're doing is connecting people to drivers. So I gave them a 40% margin. And I am putting in growth, right? And I had to estimate how much they'd need reinvest to grow. I did assume in my story that they could keep doing what they're doing, which is not own the cars, not hire the drivers. Now I still remember when Uber first started offering its service in Delhi. The way they did was they hired one guy, one person. They put him up in a hotel room, not even in a regular office. They start the Uber. Because all you had to do was connect with enough drivers, right? You hang out outside the airport, you talk to taxi drivers, would you like to drive for Uber? There you built up your growth. So the way this plays out is basically I let them grow with relatively little reinvestment, a high sales to capital ratio. Every part of my story is in the numbers. That gave me the cash flows. And what do we need to discount the cash flows? A cost to capital. We spent how many sessions on cost of capital? Remember the elaborate dance we did? Beta, risk-free rate, equity risk premium, cost of debt, debt ratio. I ignored all those sessions. How do I get away with it? It's my valuation. I can do whatever I want. Right? Besides, in this valuation, it's not even on my top 10 list of worries. So you see, how do you come up with the cost of capital? That histogram that I talked about earlier, it's built into your spreadsheets, and what's the first quartile, the median. I think I start with the 10th percentile, the 20th. So basically I give you a distributional cost of capital of all companies in the world. Do you think Uber was a risky company in 2014? I went to the 90th percentile. The cost of capital was 12%. I use that as my cost of capital. Here's my advice. If you're valuing a young company and you're spending hours, days estimating the cost of capital, you've already lost the script. Your bigger problem is estimating markets and market share and margins. You want to get there as quickly as you can. And in 2014, Uber was a young, money-losing company. Was there a chance it would not make it? Yeah. Either because they'd run out of cash or some big regulatory action that could put them on. So I put in a 10% chance of failure. Every input in my valuation is tied to a part of my story. And if you looked at the spreadsheet, it looks like an Excel spreadsheet. But if you pointed to any number in the spreadsheet and say, why is that number what it is? I'm going to tell you a story. If you ask me, why is the revenue 3.6 billion year 10? I'm not going to say I used the 30%. It's completely uninformative for me to give you a growth rate. My story is, it's an urban car service company with local networking benefits. Why is it reinvesting so little? Because it doesn't own the cars. Why is the cost of capital so high? Because it's a risky company. It came up with a value of $6 billion for Uber in June of 2014. I put this up on June 8th, 2014. It was actually a blog post at 3:15 on I don't know, might have been a Friday. I put it up. And 20 minutes later, I get a call from a Wall Street Journal reporter. She must have been sitting at her desk waiting for this post. She said, I noticed you valued Uber. I said, thank you for noticing. She said, I also noticed you attached a $6 billion value to Uber. And I said, you're very observant. She said, you do know that venture capitalists are valuing the company at $17 billion. I almost corrected her there. You know what the correction would have been, right? Venture capitalists don't value companies, but she's a journalist. I cut her some slack and said, yeah, I know they're valuing it at $17 billion. She said, how do you explain the $17 billion? I said, I don't have to. I didn't pay it. I've never felt the urge to explain what other people pay. So if you ask me, why are people paying $900 for NVIDIA? Go ask somebody who paid the $900. If you ask me, why is Bitcoin trading at 68,000? Ask somebody who paid the 68,000. Why are you trying to explain what other people... You know how much frustration this has saved me in my life? Not having to try to explain away what other people pay? So she says, are you telling me they're wrong? I said, I'm telling you nothing of the sort. I'm saying with my story, I think Uber's worth $6 billion. Maybe they have a much bigger story. You need to talk to them. And that's the way I think about value. I don't have the moral high ground or the intellectual high ground. This is my story, my value. And if you're going to make a decision, don't base it on my story, make it yours. Valuation is about taking ownership of that decision. So I finished this and I posted. And remember there's a fifth step, which is after you value something and you show it to people, what do you want them to tell you? It's amazing. It's exactly the way I would value company. And if you hang out with people who think just like you, that's exactly. So I'm saying don't hang out with other people who came from this class because you're all going to pat each other on the back. This is exactly the way we're taught valuation. You all pat each other. My advice when you value companies is show to people who think least like you, who will disagree with you. And keep the feedback loop open. In the case of Uber, I'll tell you how this played out. So I posted on my blog at June 8th. The next week I get calls from multiple outlets saying, can we carry us? First was from a site called 538.com. Have you heard of the site? It's founded by Nate Silver, used to do work at the New York Times. It's a statistics and math geek site. So it's a site where you ask questions like, does the hot hand exist in basketball? You've heard of hot hands where somebody starts shooting. So they look at the statistics. Does it actually exist? It's fun if you like statistics. So they said, we'd like to carry this because it's exactly the kind of thing our readers would like. I said, go ahead. The second outfit that called was Forbes for their online site. So 538 is read by a lot of numbers geeks. Who reads Forbes? 75-year-olds with flip phones, I think. Basically very old, aging. They said, can we carry this? Exactly the same post. I said, go ahead. The third place that called was a site called TechCrunch. TechCrunch is the Silicon Valley site read by tech geeks. They said, we like this. People are interested in Uber. I said, go ahead. And then I get a call from a guy called a guy who runs a blog called the Ride Sharing Guy. The guy still exists. He actually rides for Uber and Lyft drivers. That's his prime audience. And he said, our drivers, especially Uber drivers, would love to read this. And I said, go ahead. Same post, 4 different places. I get 4 very different kinds of response. On the 538 side, here's the question I get asked. I noticed you used a 12% cost of capital, but I check your histogram, and the 90th percentile says the cost of capital should be 11.97%. Why are you using 12%? I said, why don't you just take the spreadsheet, change the 12 to 11.97%, and see what happens. So 5 minutes later, I get an email saying, I see why you rounded it up to 12%. But that's, from 538, all you're getting is numbers, guys, caught up in the 3rd decimal point, nothing. The Forbes people just absolutely loved it. And I didn't spend any time there. This is the way they should be valuing tech companies. I moved on. The TechCrunch people absolutely hated it. TechCrunch that year reported it was the most hated article that they'd published. There were like 300 comments. And most of them were pure insults, most of which I didn't even understand. One said, you New Yorker. Is that good? Is that bad? Right? You DCF guy. That was another one. So what does that mean? Right? But basically, it's all, I couldn't even read what the implied insult was because I didn't even. So, but then you got past the pure insults. There were responses that started with an insult, like, you idiot. Let me tell you how networking works or how surge pricing works. And you know what? I'm not a ride-sharing expert. I don't spend time. So if I got past that insult, I learned something about the business I never would have learned. I don't know much about AI. I don't even know what an AI chip looks like. But you know what? After I wrote my valuation of NVIDIA, I've heard from AI engineers who work at Intel. One of them works at NVIDIA. He was not supposed to give me much of the information, but I've learned about this space. And my next valuation of NVIDIA, it's not good. I mean, it doesn't mean I'm going to change my story in a dot, but this is how you learn about companies, is by keeping the feedback loop open. So this was about June 8th, June 15th, this gets out. But 6 weeks later, I'm in Munich airport waiting for a connecting flight. Flight is delayed. I'm sitting there saying, what? Nothing to do. So I open up my phone and I check my email. And there's an email from a gentleman whose name is Bill Gurley. Those of you not familiar with Bill was a partner in Benchmark Capital. He's actually lead character in the Uber miniseries that came out. Yeah? I don't know, is it Netflix, Max, or one of them carries it. Yeah. Benchmark Capital was in the first venture capital to invest in Uber. They invested in Uber at $1 billion pricing. They were the largest single holder of Uber. Bill Gurley was actually on Uber's board, and he was rumored to be the person closest to Travis Kalanick than the CEO of Uber. So let me ask you an easy question. Does Bill Gurley know more about Uber than I do? He's probably forgotten more overnight than I know about the company. So open up the email. Here's how it begins. He said, I read your post on Uber and looked at your valuation, and I did not like it. I said, okay, we got that out of the way. He said, I've written my own blog post to counter your blog post. It's blog post to blog post warfare. Very 21st century. And he said, I've said some mean things about you, and I just wanted to let you know. Sincerely, Bill. I'm sitting in Munich airport. And of course, now I'm curious, right? So I go to Bill's. It's above the crowd. He's 6 feet 6 inches. I'm below the clouds, obviously, and above the. And it's the lead post. It's still online. You can find it. People keep sending it to me on Twitter and other sites. Yeah. Damodaran misses by a mile. Get it? I can't drive. My GPS is off. Kind of things. So it was essentially an extended piece on. Which took issue with every part of my story. He said, Uber is not a car service company, it's a logistics company. Notice how words suddenly change. What do logistics companies do? They could be in car service, they could be moving, they could be delivering. He said, Uber is not just urban, they're going to be, he gave examples of suburban and rural services that Uber could offer. And then he said, Uber is going to find a way to make its local networking benefits into global ones. And he gave an example. He said, look, you fly out of New York to go to Jakarta, you get in the United site, and you make your reservation. At the bottom of the reservation, it'll ask you, do you want an Uber waiting for you? And if you click it, so it's a clever way of saying if we dominate New York, we can extend that. I was fascinated. Along the way, he said some insulting things like Demotin has never taken an Uber, which is actually true until I actually called an Uber for the first time. And he said, doesn't know much about the ride sharing, guilty as charged. But after I read it, I'm still in Munich airport. I emailed him and said, do you want me to put a number on your story? He said, what are you talking about? I said, you've told a big story about Uber. He said, be my guest. So I open up my Uber spreadsheet and I changed 3 numbers. First, I take the $100 billion total market that I had in my valuation, which is the urban car service market, and replace it with $300 billion, which included logistics, much bigger market. Second, I took the 10% market share, which had local networking benefits, and gave Uber a 40% market share. My $6 billion becomes $53 billion. I send him the valuation. I said, do you like this more? I forgot to tell you, the ride-sharing guys, when they put my blog, I heard from an Uber driver in LA, and he said, I notice you're taking 20% of the gross billings and treating it as revenue for Uber, but that is not true. And he said, here's what's happening in LA. Uber paid me $5,000 to switch from Lyft. Lyft is now offering me $7,000 to switch back. I feel like a free agent without a contract. And by the time this is all said and done, he gave a number. It was remarkably. He said, I'd be surprised if Uber made more than 7 or 8% of the billing after all these costs. 5 years later, read a news story where Uber has admitted that their true piece of the pie is closer to 7 or 8%. My reaction was, an Uber driver told me that 7 years ago. So I sent this to Bill and I said, do you like this more? He said, a lot. I said, but he said, that 20% share is, no, we think it's going to come down. And he said, I should have told him. The Uber driver told me already. So I said, that's easy to fix. It's an input into my spreadsheet. So instead of a 20% slice, I give you a 10%. The company's worth $29 billion. When I posted this, I remember people saying, does this mean I can justify any number? I mean, these are 3 stories, and you have to decide which of these stories you believe in. So towards the end of 2000, how much I've milked this Uber thing. During the course, I have 6 posts, and end the year with a post where, have you ever been in a Build-A-Bear store? They're kind of creepy little places. Okay? You take your 8-year-old in, they give them this skin, and 35 minutes later, you got the ugliest looking bear on the face of the earth. And then they hit you with this really unfair question. They come to you with your 8-year-old next to you and say, would you like to buy this bear? It'll be $80. And you have 2 choices. You can say, no, this is the ugliest thing ever. But you have an 8-year-old who's going to scream, and you'd pay. So I created a Build-A-Bear version of a value of Uber where I said, hey, you know what? You listened to my story and you bitched and moaned that you don't like it. Why don't you build your own story? So essentially, you need stop. I said, what do you think Uber is? A car service company, a logistics company, a mobility services company. Basically, pick your pick. Is it not? So with each one, I essentially said, make your pick. Strong competitive, weak competitive, local networking benefits, global networking benefits. And the post was written in a way when you made your picks at the end, I could come back and say, given what you pick, the value for your company is. And take a look at the last column. You could end up with a value less than $1 billion. You could end up with a value of $90 billion, depending on how you frame the story. Again, I'm not saying anything goes. I'm saying how you frame the story. And some of these stories are more plausible than others. But it explains why you can get significant disagreements on the values of these companies, especially early on. So tell your story. Leave the feedback loop open. I'm going to be one part of the feedback loop. But try to expand it. If you're valuing Airbnb, you know who you should talk to? A friend or a relative actually owns Airbnb properties. Find out what it means to be an Airbnb. What are the additional? So they take 14% of the top. What else do they collect from you? Because that's what's going to drive whether your story makes sense. Last piece of the puzzle, you finished your story. Don't rest on it too long because your story can break. Me some reasons why a story can break. They say you're running a young pharma company with a huge blockbuster drug working its way through the pipeline. What causes pain?
FDA doesn't allow it.
Or even before that. Yesterday I was reading about this blockbuster drug working through a third stage of the everybody kind of accepted it. Turns out that it's